Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. We had non-farm payrolls out in the US on Friday night, as you all would have heard. But perhaps one of the things that a lot of other commentators aren't pointing out to you is there's nothing good about that data, in that it doesn't signify a strong US economy, because absolutely every other economic data series in the US is pointing south. Property prices are falling now for the third month. Stock market, we know, is down. Funds are experiencing large redemptions, which is why you need to be careful about the future for the stock market. But nothing about that non-farm payrolls number was good. It was still highly elevated above pre-COVID levels, and that is what matters. So it signals to the Federal Reserve that they need to keep taking rates higher, exactly as they have been saying they will be doing. So my target, official end rate target for this Federal Reserve interest rate hiking cycle is 5.75 to 6.5%. The market's view is that it will be around 5 to 5.25. So I'm a full 50 to 125 points higher than the market, which is great for you, because if I'm right, it gives you a tremendous market advantage. Happy days. Of course, I could be wrong, but inflation will remain resilient. The Fed wants inflation back at 2%. That's a long way away. Even the PCE rate dropping to 6% means they have to reduce it by 2/3. Chairman Powell has said himself he needs the labor market to cool further. He needs the economy to cool further. He doesn't mind if there's economic pain. His words. So when you get that non-farm payroll number, it really does highlight that the Fed will be going a lot higher for a lot longer. Now, the other interesting economic data out today was in Australia. Everyone keeps talking about how strong the Australian economy is. Sorry, I can't see it. The S&P 500 global index, PMI index for Australia today came out in contraction territory. The overall economic index, as calculated by the S&P 500 group, the S&P group, is in negative. It's contracting. That's recessionary type stuff. I've been calling a surprise recession for Australia for quite some time. I think that's still on track. Now, equity markets, that you have to say fantastic, but it was painful if you're a bear like me. That fantastic rally on Thursday is running out of steam, as well it should. But the volatility in the market is very high. What do we do? Look, if we break Thursday's high, start to worry. If we break Friday's high, start to worry as a bear. If we break Thursday's high, do worry as a bear. But otherwise, I think stay a bear, because the economy of the United States is going to go further south. We're not near the bottom of the slowdown. The slowdown is gathering pace. It's more like a snowball. It's only like 10, 15% of the way down the hill. It's going to get a lot worse. It's going to gather speed to the downside as the Federal Reserve raises interest rates tremendously. In Australia, that economic data says we're going into a recession. Retail sales have been a bit iffy. A lot of Australian corporate CEOs are getting more mindful of risk. And the RBA here too is still hiking. RBA will hike interest rates by 25 points at this next meeting. Now, that's kind of, a lot of people are like, some people think they shouldn't be hiking. Some people think they should be hiking more aggressively because inflation is higher. I don't think interest rate hikes at this point do anything to stop inflation, because the inflation is driven primarily out of supply chain disruption and a war in Europe. So you're not going to change either of those two things by raising interest rates. So all you do is you add to the pain of consumers, businesses, mortgage stress, etc. So even a 25-point rate hike to me suggests that the Australian economy will see a recession in 2023. For the moment, stocks are a little bit buoyant. Gold I like. So the things I like, and I've mentioned before at the end of last week, are buying yen, buying gold, buying bonds, US bonds in particular. So in terms of price, not yield. So I'm bullish those things. On equities, I'm still very bearish. On the US dollar, I'm a little bit more neutral. But on equities, I think I would much rather be a seller here. Australia is impressing on the day. If it can break the range of the last 3 days, good on it. That will have some further momentum to the upside. But any falling back in the price action here, and you've heard me use that phrase before, and often it's been relevant to what then happened. But any falling back into the price action here could spell another sharp downtrend for several weeks for the Australian equity market, which no one's really expecting. But gold shares might be an interest. Gold generally I like. The Australian dollar, very tricky here actually. So yeah, I'm less firm on my US dollar view at the moment, just a little bit cautious, neutral there, but still bearish equities, still like the yen actually. I like all of Asia going through next year as being stronger and more resilient to the global slowdown than Europe or the United States will be. Have a great day and week ahead. Thank you very much.